What if I told you that while millions of investors are celebrating new highs in the stock market, Warren Buffett is quietly doing something completely different? He's selling, not because he's afraid, not because he's panicking, and not because he's suddenly lost faith in America, but because he may be seeing something that most investors are missing. And one of the biggest clues comes from a company he's owned for years, Bank of America, a stock that once represented one of Berkshire Hathaway's largest investments, a stock that generated billions of dollars in profits, a stock Buffett seemed perfectly happy to hold. Until now, because recently, Buffett started reducing his position. At the same time, Berkshire Hathaway accumulated one of the largest cash piles in financial history. And that raises a question every investor should be asking. Why would one of the greatest investors who ever lived sell stocks and build cash while everyone else is buying? Stay with me, because the answer has very little to do with predicting a crash and everything to do with understanding risk. And by the end of this video, you'll understand why Buffett's actions may be one of the most important lessons investors can learn right now. The move that caught Wall Street's attention. Let's start with the facts. For years, Bank of America was one of Berkshire Hathaway's crown jewels. It wasn't a small position. It wasn't an experiment. It was one of Buffett's largest and most successful investments. The bank benefited from rising earnings, strong consumer activity, and a resilient financial system. Everything seemed fine, which is exactly why Buffett's decision surprised so many people. Because when Buffett starts reducing a major holding, investors pay attention, not because they blindly copy him, but because Buffett rarely makes large portfolio changes without a reason. And that's where the story gets interesting, because the reason may not be what most people think. The question everyone is asking, whenever Buffett sells, the headlines immediately appear. Is a crash coming? Does Buffett know something? Should investors be worried? But here's what most people misunderstand. Buffett didn't become Warren Buffett by predicting recessions. He didn't build his fortune by forecasting every market correction. He built it through discipline, patience, and value. That's a very important distinction, because Buffett isn't trying to guess what the market will do next week, or next month, or even next year. Instead, he's asking a different question. Is the reward worth the risk? And right now, that question may be harder to answer than many investors realize. The hidden reason most people miss. Here's where things become fascinating. Most investors focus on what Buffett sold. Very few focus on what he kept. Cash. Lots of cash. An extraordinary amount of cash. While investors chase opportunities, Buffett has been accumulating flexibility. And that's exactly how he sees it. Not as inactivity, not as fear, but as optionality. Because cash gives him something priceless. The ability to act when everyone else can't. Think about that. When markets become expensive, opportunities become rare. When opportunities become rare, patience becomes valuable. And Buffett has spent decades proving that patience is one of the most powerful advantages in investing. Now let's talk about something investors rarely discuss. Human psychology. Because markets aren't driven only by numbers. They're driven by people. And people are emotional. When stocks rise, confidence rises. When confidence rises, risk feels smaller. And when risk feels smaller, people begin taking bigger risks. That's when problems begin. Because risk never disappears. It simply becomes harder to see. And history has shown us something fascinating. The moments when investors feel safest are often the moments when discipline matters most. Buffett understands this better than almost anyone, because he's seen it happen repeatedly throughout his career. A lesson from history. Let's go back in time, not to one specific year, but to a pattern that has repeated itself over and over again. Markets rise. Investors become optimistic. Valuations expand. Excitement grows. And eventually, people start believing things are different this time. Sound familiar? It always feels different when you're living through it. Every generation believes its story is unique, yet the underlying psychology remains remarkably similar. Greed, fear, optimism, euphoria. These emotions have influenced markets for centuries, and Buffett has built an entire investing philosophy around understanding them. Why Bank of America matters. Now let's return to Bank of America, because this isn't really a story about a bank. It's a story about discipline. You see, selling a stock doesn't automatically mean something is wrong with the company. A company can remain strong, profitable, well-managed, and still become less attractive from an investment perspective. Why? Because investing isn't just about finding great businesses. It's about finding great businesses at attractive prices. And that's where many investors get into trouble. They focus entirely on the quality of the company and ignore the price they're paying. Buffett never makes that mistake. The danger of overpaying. Imagine two investors. Both buy shares in an outstanding company. Both hold for 10 years. Both believe in the future. Yet one investor dramatically outperforms the other. How? Fundamentals. Future returns often become more challenging. That's not fear. That's mathematics. The real warning. Here's what I believe is the true warning hidden inside Buffett's actions. It's not sell everything. It's not the market is doomed. And it's not a recession is guaranteed. The real warning is simpler. Don't let excitement replace discipline, because that's exactly what happens near the end of many market cycles. Investors stop asking difficult questions. They stop evaluating risk. They stop caring about valuation. And they start assuming prices will continue rising forever. History suggests that's a dangerous mindset. What investors should do. So what should investors do right now? First, stay rational. Second, understand what you own. Third, avoid making decisions based on fear or excitement. And fourth, remember that patience is a strategy, not a weakness. The market will always create opportunities. The challenge is having the discipline to wait for them. That's something Buffett has mastered, and it's one reason he's remained successful for so long. The question that changes everything. Instead of asking, why is Buffett selling Bank of America? Ask yourself something more important. What lesson is Buffett teaching? Because the answer isn't about one stock. It's about a mindset built on patience, discipline, risk management, and long-term thinking. Those principles don't change. Markets change, headlines change, trends change, but principles remain. And that's why Buffett's actions continue to matter. So, why is Warren Buffett selling Bank of America? Maybe the answer isn't that he's predicting a crash. Maybe the answer isn't that he's bearish. Maybe he's simply doing what he's always done, protecting capital, managing risk, and waiting for opportunities, while millions of investors focus on what happens next.